Ticker symbol FI is up over 53% in the past year, and today we'll be looking at a medium cap with high client retention, which is a great growth machine, as it has solid fundamentals and rising efficiency ratios, and it has a 34% year-over-year net income growth. So today we'll be looking at Fiserv, a financial services company. In their annual report, they state that they're a leading global provider of payments and financial services technology solutions. This company basically works with banks and other financial institutions and enables them to provide secure financial transactions, manage electronic payments, and support the digital transformation of these banks and other financial institutions. The amazing thing about this company is that most services that they provide are actually necessary for their clients to keep operating, meaning that it would not be affected by cyclical risks, for example, because a bank would need to rely on this company in order to keep securing financial transactions or offering electronic payments. Their biggest segment is called processing and services, and the revenue from here actually represented 82% of the company's total revenues in 2023. This service consists of multi-year contracts which have extremely high renewal rates. This is great because it means that the company has almost like a subscription-based product, and high retention rate allows them to maximize the lifetime value of their clients without the need to spend on business development or advertising for their products. In the annual report, they lay out a growth strategy which can be broken down into two main points. The first one being that they want to increase the number and the breadth of their clients by, first of all, expanding their portfolio, but also combining products and services in order to enhance cross-selling. So what they want to do is to bundle different services that they offer together in order to sell more expensive services to their clients, gain more value per customer, and overall keep their customers happier. Now, the second part of their strategy involves enhancing operational efficiency by reducing costs while improving the quality of their services through scale opportunities. What this generally means is that over the next quarters, we will see their margins actually expanding, their net income and their free cash flow generation increase. But when we look at their financials, we can see that they're very good. There are two things that I'm not too happy about. First of all, being the 9% return on capital employed, because I believe that this company can do a lot better. They do not need to be asset heavy as they're offering services which are primarily digital. So I think we could see this in the future rising above our threshold of 15%. And the second of all is that they have a 5 times interest coverage ratio. Of course, they could do better in this aspect, but since their revenues and profits are extremely consistent, I would not worry too much about this. They have a very solid cash conversion, which is close to 80%, a profit margin which is at 61%, and an operating margin above our threshold sitting at 17%. The good thing about this company is that their total revenues, their gross profit, and their net income have increased every single quarter, with both their margins actually expanding quarter after quarter. Now, the efficiency ratios tell a very similar story as they have all been rising consistently. The one we should focus on, return on invested capital, is comfortably sitting at around 17%, which is extremely solid. And they have a very solid current ratio because their total assets are sitting way above their total liabilities and have been doing so for the past 5 years. Additionally, this company gets a 7 out of 8 score for the fundamental analysis. The only thing that I didn't like being their low liability risk, as they have a 5 times interest coverage ratio, and I know they can do better than that. Now, this company has a very solid balance sheet as they can cover their short-term liabilities only using their current assets. This company is generating extremely consistent cash flows which are growing organically, and this is being allowed by the organic revenue growth. And as always, by organic I mean that they don't need acquisitions in order to grow their top line. Now, this company does not pay dividends because they prefer to invest it back into their business. What I did like, however, is seeing the fact that their shares outstanding are decreasing over time, which implies that they're actually conducting share buyback programs whenever they see their stock trading at low prices. And finally, the two most important qualities for a company are the pricing power and the existing moat or competitive advantage. When looking at the pricing power, this company has a lot of it, mainly because they're offering a service that is more of a necessity for banks and merchants. As we stated previously, the majority of the services that they offer are actually needed by their clients in order to keep operating. So if Fiserv decides to raise their prices of their services by a 5% every year, what other alternative do banks and financial institutions have? They cannot just stop paying for their services because that means that they would have to stop actually operating or providing other services to their clients, and they cannot just switch to a different provider. This is where their existing moat and competitive advantage actually comes in. Their clients will actually find it hard to switch because of two main factors. The first one being that this company has reached a size and a scale where everything that they do will be a lot cheaper than all their other competitors, because they have all the contacts in the industry and they're buying at a scale, which means that they will get discounts on all their other services or outsourcing that they do in order to provide the best service for their clients. And reason number two is that once a company starts using Fiserv's services, there are massive switching costs. This means that if a company wants to hire these services instead of from Fiserv from another competitor because they have cheaper prices, they will have to pay for a whole project again of installing the different services, retraining their employees, and any other related costs that may be attributed to this. This is why Fiserv has such high retention rates and multi-year contracts. Now, when we look into their valuation analysis, we can see that they're currently trading at a 30 times PE ratio, which for a company of its growth rate is relatively okay, and comparing it to its historical averages, it's trading at a reasonable multiple. Now, they offer a 3.75% free cash flow yield, which when comparing to the 3% long-term inflation rate, actually also suggests that this company is trading at an attractive price. And looking into risks and possible challenges, there are only two that I see, but I wouldn't be too worried about them. I think Fiserv is a great company. The first one would be the worsening competitive landscape. As this is such a profitable and attractive industry, there are so many new competitors trying to enter this space on a regular basis. Of course, in terms of Fiserv, since they already have multi-year contracts and there are high switching costs if their clients ever wanted to go with someone else, this is relatively okay in the short term. However, they do have to watch out as the other companies are extremely innovative, they can pivot quickly, and they may be able to offer more value just by switching to newer technologies. So Fiserv has to go one step ahead and keep offering excellent services to all their customers so that they can retain them for even more time. The second risk that I saw is actually not meeting performance objectives. And this is mainly related to the fact that if they have actually been finding it hard for clients to actually hire any other of their services, they will probably have a hard time doing so at the current moment. Even if they try to bundle it with other services, clients that have been with them for a long time will just want to stick to whatever they have and have been paying for the past 3-4 years. However, I wouldn't worry too much about this one. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a very strong competitive advantage. They're offering consistent, predictable, and growing cash flows, but they do not have a higher return on capital employed yet. However, I do believe that this is a good company and it is probably a good investment, which is worth taking a deeper look to analyze it thoroughly. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.